Is what you raise from investors' debt or is it equity? The IASB has argued over that question for more than a decade. And in 2026, they're still not finished fixing it. Today, the one rule that decides it every time. A financial instrument is a contract that creates a financial asset for one party and a financial liability or equity instrument for another. You met this in IFRS 9. IAS 32 answers the harder question. Which side of that line is it on? The test is blunt. Does the issuer have a contractual obligation to deliver cash or another financial asset? Yes, it's a liability. No, it's equity. Not what you call it, not how it's labeled, what you're contractually obliged to do. One sharp exception worth knowing: the fixed for fixed test. A contract to issue your own shares is equity only if it's for a fixed number of shares, for a fixed amount of cash, no floating, no formula. Change either side and it usually becomes a liability, and a narrow carve-out. Some puttable instruments, common in partnerships and cooperatives, are classified as equity even though holders can force a cash payout if strict conditions are met. Definitions are one thing. Let's put this to work on the trickiest instrument there is: a convertible bond. Meet Meridian Ltd again. It issues a 3-year convertible bond, 1 million euros face value, paying a below market coupon of just 4%, because investors are also buying the right to convert into Meridian shares later. A plain bond with no conversion right would need to pay 7% to attract the same investors. That gap is the clue. IAS 32 says, split it. Discount the bond's cash flows, the coupons, and the principal set the market rate for a plain bond. Without the conversion option, 7%. That present value is the liability component, 921,271 euros. Whatever's left of the 1 million proceeds, 78,729 euros, is the equity component. One instrument, two components. Day 1, debit cash, 1 million. Credit the liability component, 921,271. Credit equity, a separate reserve, not share capital, 78,729. Two sides of one contract recognized as what they actually are. Here's what's easy to miss. After day 1, only one of those two components ever moves again. The liability component behaves exactly like the debt you already know from IFRS 9. It accretes at the market rate, 7%, using the effective interest method. Year 1, interest expense 64,489, cash coupon paid 40,000, the gap 24,489 adds to the liability. Run it 3 years, and the liability grows to exactly 1 million. The full face value, right on maturity. The equity component, it never moves. Once split, it's fixed for the life of the instrument. Two more traps worth knowing, and then one rule that lets you show two numbers as one. First, treasury shares. If Meridian buys back its own shares, they're deducted straight from equity, at cost. No gain, no loss, ever, no matter what price it buys or later resells at. You cannot make a profit trading your own shares. IAS 32 shuts that door completely. Second, offsetting. Meridian has a 500,000 euro loan with its bank and a 200,000 euro deposit with that same bank under a legally enforceable netting agreement intending to settle net. Show it as one number, a 300,000 euro net liability. Change either condition, no legal right or no intention to net, and both show gross, full amounts, side by side. You can't net two accounts just because you feel like it. One more thread that ties it together: interest, dividends, gains and losses follow the classification you just made. Pay interest on the liability component. It's an expense, straight through profit or loss. Pay a dividend on equity. It's a distribution of profit, never a cost against it. Same cash leaving the business. Completely different effect on the numbers investors read. So why is the IASB still fighting over this in 2026? Because the line isn't always this clean. The current battleground, instruments that carry both debt and equity features at once. Perpetual bonds, some preference shares. The IASB proposed sharper rules in 2023. Closed consultation in March 2024, and as of early 2026 is still redeliberating the details. No final amendment yet, but when it lands, it'll tighten exactly the test you just learned. And IAS 32 never stands alone. It answers one question: is it debt or equity? Once you know that, IFRS 9 tells you how to measure it: amortized cost or fair value. And IFRS 7 tells you what you must disclose about it: present, measure, disclose. 3 standards, 1 story. Why does any of this matter to an investor? Because classification moves gearing. Reclassify a permanent instrument as debt, and leverage ratios jump overnight. Nothing about the business changed, only the label. And it moves profit. Interest is an expense. Dividends aren't. 2 companies raising the identical amount of capital can report completely different profit margins, purely from how they structured the deal. Let's land it on Meridian's own accounts. Non-current liabilities. The bond's liability component, growing each year toward $1 million. Equity. A separate convertible bond, equity reserve line, a fixed $78,729, untouched. 2 numbers from 1 contract, exactly where IAS 32 says they belong. 1 test decides it. Is there a contractual obligation to deliver cash? Split compound instruments by the residual method. Treasury shares. No gain, ever. Offset only with a legal right and the intent to settle net. And interest hits profit. Dividends don't. That's IAS 32. Now you know the rule this whole cluster stands on. We've already covered IFRS 9, how to measure what you just classified. Next, IFRS 7, and everything you have to disclose about it. See you there.